ever feel like you're trying to navigate the world of trading with a map that's constantly being redrawn?
Oh,
You're
absolutely.
sifting through just endless information, looking for that signal amidst, well, all the noise.
Yeah.
So today we're doing a deep dive into a listener's resource, the book Ways of the Trade from 2013.
Right.
Our goal really is to pull out the core wisdom from this book to help you, our listener, understand the fundamental shifts in how markets operate and, I guess, how to think strategically.
Exactly. And Ways of the Trade, it offers more than just, a set of rules. It really gives you a framework for understanding this evolving market landscape.
Okay.
We're going to focus on the insights from this book that still hold up and see how they can shed light on today's trading environment.
Okay, so the book kicks off with this idea of achieving consistent profits through, like, masterful execution, almost like a skilled artisan adapting their craft, right?
Yeah, precisely. Like a katana is the analogy used.
The katana. Okay, what's the central idea behind this way of the trade philosophy then?
Well, at its heart, it's about mastering three fundamental questions. When is the right time to actually engage?
Okay.
Where should you trade? Considering the big picture, the macro stuff.
Right.
And then how do you actually execute your system, your approach?
Simple questions.
Sounds simple, right?
Yeah.
But the author points out the real challenge is grappling with the hidden complexities, the stuff that can really trip up traders, even experienced ones.
Yeah.
It's not just about having a strategy. It's knowing when and where to apply it effectively. That's the key.
That makes total sense. The devil's always in the details, isn't it?
Always.
The book then talks about a pretty big shift, the decline of sort of traditional day traders around 2009. What was behind that, according to the author?
Well, the author suggests a few things came together. The increasing demands of actually being there, trading all day.
Yeah, the time commitment.
Right. And combined with inconsistent profits across different market conditions,
Yeah.
it just got tougher.
So performance issues, too.
Yeah, and maybe tolerance for pullbacks?
Yeah.
The core insight, I think, is the market just became way more demanding, more competitive. It pushed out people who couldn't adapt to the speed, the sophistication.
And this is where things get really interesting because right around then, high-frequency trading, HFT, really exploded onto the scene.
Exactly.
How did these super-fast programs reshape everything?
Well, HFTs fundamentally changed how markets work. These programs running at just incredible speeds, they started dominating order flow.
How so?
But just filling available orders instantly, like swiping liquidity, as the book puts it. And that squeezed profit margins for traditional traders, and it probably contributed to bigger price swings, too.
And they had specific techniques.
Oh, yeah. Things like bid stuffing, rapidly placing and canceling tons of orders. It just muddied the waters, made it harder to get your orders filled where you wanted.
So it wasn't just faster, it was different.
Totally different. The key insight isn't just the speed. They fundamentally altered the game. They became dominant in liquidity and execution. It was a paradigm shift, like high-speed internet changing everything.
And it wasn't just about the open exchanges, was it? The book mentions dark pools. What were those about?
Right, dark pools. These are basically private exchanges, not very transparent. They got more popular mostly with big institutions.
Why?
Think of them as hidden marketplaces. Big players could trade large blocks without tipping their hand to the wider market immediately.
Okay.
But it fragmented things.
Right.
Made it harder for everyone else to see the full picture of supply and demand.
All this sounds like it created a much more jumpy, less predictable market. The book even links this to the flash crash in 2010.
Right.
What's the connection?
Yeah, the author's take on the flash crash is pretty insightful. They argue HFTs weren't necessarily the sole cause. Like, they weren't actively betting against the market initially, but they acted as accomplices. They rapidly added to the buying pressure, piled on, and then just as quickly pulled their bids. Vanished.
Amplifying the fall.
Exactly. Amplify that dramatic drop. And shows us a key thing about HFTs. They can create this illusion of deep liquidity, but poof, it can disappear in a flash.
Right.
The author even suggests some HFT-driven rallies might lack real support, creating a kind of hollow core.
So this wasn't the first time day traders faced major headwinds, though. The book looks back at 2000 to 2003, the so-called death of day trading. What was that about?
Oh, yeah, that was the dot-com bust. The NASDAQ collapsed. Long bear market.
Brutal time.
Absolutely. Big tech names just plummeted. Yahoo, Palm, JDSU, names you might remember.
Yeah.
It triggered margin calls everywhere, wiped out a lot of day traders. The book even mentions IPO execs suddenly owing huge taxes on worthless stock options. Just widespread financial pain.
Ouch.
A key takeaway there is just how fragile speculative bubbles are and the need for risk management. Mark Cuban apparently navigated that quite well, unlike many others.
And then the pendulum swung back again. The housing bubble, the bull market from 2004 to 2007.
Yeah, the market started climbing back. Day trading was still tough. Regulations were tighter, spreads narrower.
But activity picked up.
Program trading started getting more active again, yeah. But the big focus shifted, didn't it? To
Yes.
housing, real estate, those complex financial products.
Right, mortgage-backed securities and all that.
Exactly. Investment banks were making a killing. And interestingly, the author notes how public interest kind of shifted from stock trading to flipping houses. Shows you where the narrative was.
Okay, so we've seen these massive shifts. Market structure changes, HFTs take over. How does the author suggest actually trading in this environment? How do you deal with liquidity now?
The emphasis is really on needing a robust, consistent system, one that feeds on volume and movement.
Okay.
The idea is to try and anticipate the breakouts or breakdowns before they fully happen, get in at those impact points.
Right at the critical level.
Yeah. And this is important. Exit relatively early. Take profits into the momentum that HFTs often create.
Yeah.
Don't get greedy.
Because they might pull the rug out.
Precisely. The GMCR example in the book illustrates that perfectly. Big HFT spike, then bam, it reverses hard. So don't try to squeeze out that last drop.
Makes sense. Avoid getting caught when they flip. And how does the author define true liquidity versus what HFTs provide?
Well, true liquidity is seen as genuine buy and sell interest. Real participants willing to be counterparties. The book calls it a sponge.
A sponge.
Yeah, soaking up orders. HFTs, in this view, are more like middlemen. They aren't the fundamental sponge. They can actually dilute or distort the perception of liquidity for their own gain.
The book uses another analogy, too, about being outgunned in a pond.
Yeah.
How do you adapt if you're the smaller fish?
Right, the pond analogy. It highlights competing against faster, better-equipped players. The advice isn't to try and outgun them directly.
So what do you do?
You focus on understanding the landscape, climate, and terrain, meaning the overall market conditions, the volatility levels, key technical spots. Use your knowledge of the environment as your advantage, like survival, right? Knowing that terrain can beat superior firepower sometimes.
Okay, let's shift to this concept of the law of transparency. What's the core idea?
The basic idea is that a lot of algorithms, algos, are built on predictable rules. If this happens, then do that.
Triggered by price levels.
Often, yeah. Triggered by mass reactions at well-known technical stress points. The law of transparency suggests that as these classic patterns become too obvious, too widely followed,
They stop working as well.
exactly, their edge fades, which ironically can then create an edge for maybe less common patterns, anomalies.
Until it gets too popular.
Right, until they become transparent too, and the cycle potentially reverses. It's a constant adaptation.
So it's not just about knowing patterns, it's about knowing how everyone else is reacting to those patterns.
That's the deeper insight, yes. It's about gaming the reactions of the counterparties, as the
Yeah.
book puts it. It's a shifting process, not a fixed rule book.
Because market behavior cycles.
Precisely. Relying solely on concrete rules is dangerous. You need to understand the landscape, the context, especially when your usual indicators or systems seem to fail.
The book also introduces climate in the markets. What does that mean?
Climate is basically the tradability of the market at any given time. Is it conducive to making trades?
Like weather.
Kind of. A wet climate is good, high volume, good liquidity, price moves that actually follow through, lots of opportunities.
And dry.
Dry is the opposite. Low volume, choppy action, moves that fizzle out, consolidations, tumbleweeds rolling by, as the author colorfully puts it.
And how does this climate affect how you should trade?
Massively. It impacts your efficiency, whether a setup is even likely to work. The book makes the point that a sloppy trader might actually do okay in a wet climate.
Says everything's moving.
Right. While a really skilled trader could get chopped to pieces in a dry climate if they don't adjust.
So assess the climate and adapt.
Absolutely. Adapt your tactics. Maybe trade smaller, be more patient, look for different kinds of setups depending on whether it's wet or dry, both in the overall market and the specific stock.
This adaptation ties into another core idea, focusing on process over profit. What's the philosophy there?
The author really hammers this home. Focus on executing your process well, consistently, continually manifesting excellence, is the phrase used.
And profit follows.
Profit becomes the byproduct. That's the belief. If you just chase profits,
You make mistakes.
you end up chasing, panicking, maybe even gambling. It leads to bad decisions driven by P&L swings rather than your system. The insight is, a solid process executed consistently is the path to long-term profitability.
The book even gives a name to dwelling on missed trades. SWC disease?
Yeah, SWC. Shoulda, woulda, coulda.
We've all been there.
Totally. But the author sees it as a really detrimental mindset, fixating on hypotheticals, oh, I should have held longer, instead of learning from the actual trade and focusing on the next setup.
Because conditions change anyway.
Exactly. Dwelling breeds regret and messes with your head for future trades. Review, learn, move on.
Okay, let's switch gears to specific market events. How does the book view trading around earnings season?
Earnings season is painted as a classic wet climate. Lots of volume, volatility, news flow, big opportunities.
Because of the reports.
Right. The typical reaction is stock goes up on an earnings beat and raised guidance, down on a miss or lowered guidance. Pretty standard.
But potentially very tradable.
Very. The author calls it forgiving for nimble traders. Mentions scaling techniques too, like defensive and offensive sprawl, which we might touch on later. But yeah, expect unusual price action too.
And what about global events? Macro news, politics? How should you factor those in?
The advice is pretty clear. Don't try to predict the outcome of these events.
Focus on the reaction.
Yes. Focus on how the market reacts to the news. The market's focus jumps around anyway, right? One week it's European debt, the next it's the U.S. fiscal cliff, then central bank comments.
So be reactive, not predictive.
Be nimble, be responsive to what the price action is telling you about the market's interpretation.
The book also touches on breadth indicators. What are they and what's the author's view?
Breadth indicators try to gauge market health by looking at participation. How many stocks are moving up versus down?
Like the advanced decline line.
That kind of thing, yeah. The author notes that when participation drops, liquidity tends to get concentrated in the big cap names.
Leading to divergences.
Potentially, yeah. Where the main indexes look okay, but underneath, fewer stocks are holding things up. Sellers might use bounces in the SPY to unload weaker stocks, trapping people on sell-offs.
So does the author use traditional breadth indicators?
They seem to prefer monitoring their own curated watch lists of global leaders and top trading stocks, rather than relying solely on conventional breadth metrics.
Now, the book breaks down different trading skill sets. Day, swing, investor, portfolio. Quick rundown.
Sure, day trading. All about speed, precision, shortest holding times. Scalping.
Got it. Swing trading.
Swing trading. Looking for multi-day patterns, wider time frames, need more tolerance for volatility, maybe hedging. Holding overnight or for a few days.
Investor.
Investor, much longer-term focus. Trends, macro view, fundamentals. High tolerance for price swings is key.
And portfolio trading.
Portfolio trading is presented as the synthesis, the seamless fusion of all three, adapting your style as needed.
The author uses Kurt Warner, the NFL quarterback, as an analogy here. What's the point?
Yeah, the Kurt Warner story coming back from bagging groceries to NFL MVP, it's used to illustrate resilience, rebirth after boom and bust cycles.
With day traders after the crash.
Exactly. Or adapting to HFTs. The message is, your skills are still valuable, but you must apply them in the right context, the right landscape, climate, and terrain.
And the modern trader needs.
Needs to be a hybrid fighter, according to the book, skilled in scalping, swinging, and portfolio management. Adaptable.
The book talks about finding pockets of opportunity. What are these exactly?
Pockets are specific, often temporary, situations offering an edge. They relate to execution factors like transparency, liquidity, momentum.
Okay.
Or market conditions like divergence, reversion to the mean, convergence, things lining up just right.
But they don't last.
Usually not.
Yeah.
As they become more obvious, transparency increases, the trade gets crowded, and the pocket shrinks or disappears. So you need to spot and react to fresh pockets.
Managing emotions is huge, obviously. What's the take on optimism versus pessimism?
It's about using them strategically, I think. Recognizing when the crowd is maybe too bullish or too bearish, and potentially fading that sentiment.
And dealing with losses.
Crucially, don't beat yourself up over small losses if you followed your system consistently. Focus on the long-term positive expectancy of the process. Consistency is key.
Preparation keeps coming up. The book really stresses a structured morning ritual. Why so vital?
It's framed as absolutely critical. Like a fighter's training camp, the real work happens before the bell rings.
To find good setups.
Yes,
exactly. To gather high-quality ingredients, which are filtered prospects, potential trades. It's a self-directed, systematic process to set the stage.
Can you walk us through the key parts of this ritual?
Okay, yeah. It involves.
Identifying the headliner gap or dumpers, stocks opening way up or down. FinViz heat map is mentioned as a tool,
Okay.
too. Analyzing stocks on multiple time frames, the book says 7, from 1 minute to monthly, focusing on wider frames pre-post market.
7 time frames. Wow.
Yeah, thorough. 3, noting specific patterns like pup or mini-pup formations and overlapping support-resistance bumpers, especially close ones on daily, weekly, monthly charts.
Right.
4, finding stocks with daily pup patterns that haven't triggered yet, maybe checking 60-min stochastics.
Looking for potential energy.
Exactly. 5, maybe including a laggard stock that hasn't moved with its sector.
Yeah.
And 6, reviewing your tracked organic stocks, the ones you follow closely.
That's quite a checklist.
It's comprehensive, sets you up for the open. So the market opens. How should you approach those gapping stocks you identified? What happens next?
The book outlines 3 typical reactions right after the open. First, often a violent spike or dump in the direction of the gap.
The initial knee-jerk.
Right. Second, usually some kind of reversion or pullback from that initial move,
Fading the first move.
potentially.
Yeah.
And third, the possibility of a real trend developing after that initial noise settles down.
And the advice is?
Be very wary of chasing that first violent reaction. It's often HFTs and institutions battling it out. Focus more on potentially playing the second reaction, the reversion, or the third, the emerging trend.
Okay, and the wet versus dry climate idea comes back here too, right? After the open?
Yes. The author reiterates, dry climates, often midday, means smaller, shorter opportunities, more chop, less agreement between time frames. Setups might fail more easily.
So trade differently.
Definitely. Be more conservative in dry periods. Use stops maybe more readily if you're less experienced. And recognize setups just take longer to form. Waiting 15 minutes or so after the open in a dry climate can be smart. Let the dust settle.
The book revisits the law of reciprocity regarding the morning ritual. How does that apply?
It connects the effort you put into preparation with the results you get. Consistent, diligent prep work. The byproduct idea, again, tends to produce worthy results. It's not just luck. It's earned through that structured effort.
Got it. Let's talk about some specific trading terms. Stinky Fies bumpers, what are those?
Yeah, memorable name. It refers to the observation that price often finds support or resistance around the 40, 50, and 0.60 levels within every $2.50 increment.
Like $20.40, $20.50, 25 and 26 cents?
Exactly. Then $22, $93, $23, $23.10. Wait, no. $22 and $52, $22.60. Those levels, they can act as initial hurdles and then strong support once broken, de facto bumpers.
Interesting. And mystics?
Mystics are just bad price prints, erroneous data points that usually get smoothed out quickly.
Do they matter?
Well, algos can sometimes react to them, trigger orders based on bad data, and human traders can get flushed out by the sudden weird print, too.
Any useful info from them?
Sometimes, a mystic way above or below the market might hint at desperation among longs or shorts, trying to trigger stops or something. It's a subtle clue, maybe.
Okay. The book also has a nuanced take on stop losses, calling it the essence of stops. What's the idea beyond just limiting loss?
Right. It's not just about damage control. Stops are also seen as information gatherers, like little tester weather balloons.
How so?
The book describes 3 levels. 1, basic protective stops, the standard loss limit.
Okay.
2, tactical stops, where you place them considering the market context, volatility, key levels, not just a fixed percentage.
More strategic.
Yeah. And 3, stops used to gauge undercurrent depth. Here, getting stopped out on a small initial position might actually provide information that feeds into a potentially larger trade later, maybe even a reversal. It's about reading the reaction at the stop level.
That's a deeper way to think about them. This links to performance transparency, framed as A plus B is C. What does that mean?
Simple equation, profound idea. A and B are your process research, strategy, execution, mindset, all that. C is your result, your profit or loss.
So C reflects A and B.
Directly. Your results are the transparent reflection of how effective your process is. And the book notes you often see subtle clues, hairline fractures in performance, before the results completely crater. Early warnings if you're looking.
And if things are going wrong, the book offers remedies for affliction. Like what?
3 main approaches: counteract, diffuse, dilute.
Dilute. How?
Dilution means broadening your focus. Don't get fixated on just one stock, especially if it's causing you pain. Increase your prospect list. Keep at least 3 potential trades in view after your first trade of the day.
Avoid tunnel vision and revenge trading.
Exactly. Also suggest maybe trimming allocation size for flexibility, hedging if needed, And crucially, do your research before trading levels 1 and 2. Don't try to figure things out and make back losses on the fly.
Makes sense. What about DSS, defensive sprawl scaling? Sounds risky.
It is an advanced technique,
Yeah.
definitely for experienced, nimble traders. It means adding to a losing position at key support levels, but only when those levels align with wider time frames.
So it's not just averaging down randomly.
Absolutely not. It's
Okay.
not an excuse to avoid stops. The goal is very specific. Average your cost strategically for a quick reversion scalp if the support holds. Needs precision.
Okay. The book brings up perfect storm patterns again, linking transparency and opportunity. Remind us of the idea.
The core idea is that inverse relationship again. The more perfectly clear textbook a perfect storm setup looks,
The less opportunity is left.
often, yeah. By the time it's obvious to everyone, the main move might be over or close to it. The edge is often in recognizing it before it becomes perfectly transparent.
But you can still potentially trade it.
Maybe. The book suggests you can still make money sometimes, even after the fact. But again, consistent effort earns rewards, not just stumbling onto one perfect-looking trade that's already played out.
And what happens after a perfect storm tries to break out or down? What are the outcomes?
3 main possibilities. 1, it breaks and trends successfully.
The desired outcome.
2, it chops around, goes sideways, doesn't really commit.
Frustrating.
3, it fails, fades, and reverses. Volume can be a key tell here. Low volume on the fade might just be chop. High volume suggests a real reversal.
Then a failed perfect storm.
Can reverse hard, especially if the overall market, like the SPY, reverses at the same time. Traps a lot of people leaning the wrong way.
For listeners trying to grasp this perfect storm, can we simplify the checklist? What are the absolute key ingredients?
Okay, simplified. Look for alignment across multiple time frames, like 60 min, daily, weekly lining up. Proximity to key support resistance, bumpers. Volume confirming the potential move. And check if it correlates with the broader market, SPY. That's the gist.
Got it. And there's a variation called a tightening perfect storm?
Yeah, this is specific. It's when a stock peaks, slips below a key moving average, like the 5 period, and then consistently fails on any bounce attempts back to that moving average.
Right.
Gets rejected repeatedly.
Pushing it lower.
Right. And again, you want to see this happening across multiple time frames simultaneously for higher probability.
Wow. Okay. Then there's DHSS double-hedged sword sequence play. Sounds complicated.
It is more advanced. DHSS tries to capitalize when you see opposite perfect storm patterns setting up at the same time in related instruments.
Like one stock looks ready to break out, another looks ready to break down.
Exactly. Maybe a sector leader and a laggard, or 2 correlated EPFs. The idea is you take positions on both sides,
Why?
because you could potentially win regardless of which way the overall market, SPY, moves next. If SPY spikes, you trim the long winner. If SPY pulls back, you trim the short winner.
A hedged approach.
Kind of. But you have to manage the timing, the fade duration. One side might just turn into a dud. It requires skill.
Let's move to the research process. The book outlines 4 levels. Can you summarize them quickly?
Sure. Level 1, fast chart analysis. Quick look at 60 min, daily, weekly, monthly charts. Find key bumpers, patterns, like the EET example chart in the book.
Okay, technical snapshot. Level 2.
Pure analysis, reading news, message boards, Yahoo Finance, Benzinga mentioned. Gauging sentiment, finding secondary info.
Getting context. Level 3.
Deeper dive, fundamentals, SEC filings, earnings transcripts, company website, financials, patents, lawsuits, debt load, the serious digging.
The groundwork. And level 4.
Level 4 is the juicer. This is full immersion, synthesizing everything to shape the story. Finding the sexy catalysts, takeover buzz, hidden assets, new themes, regulations, developing your own unique organic view. The law of byproduct applies to research. Too deep effort yields insight.
This sounds like it relates to the playability of stocks. What makes a stock playable?
It's 2 things, really. Internal factors, your own familiarity, your comfort level trading that specific stock.
Knowing its personality.
Yeah, and avoiding traps like fixed dollar allocation, putting the same cash amount into a $10 stock as a $100 stock doesn't make sense risk-wise.
Right. And external factors.
That's the stock itself. Its volatility, its liquidity, can you get in and out easily, the news flow around it, and how it correlates with its sector.
Speaking of sectors, how do you gauge those correlations?
The book notes that markets have sector and intrasector correlations. Leaders, often higher-priced stocks, tend to pull their peers along.
I need to check that.
FinViz is mentioned again as a resource for checking current correlations. Knowing this can give you ideas. If a sector leader makes a huge move, you might look to play its peers.
The book also lists Most significant news situations. What are some highlights?
Key catalysts mentioned are earnings stuff, surprises, guidance, conference calls, even retail sales figures, FDA decisions for biotechs, huge moves on approvals denials, legal regulatory things, patent suits wins, losses, settlements, those patent trolls,
Yeah.
stock structure changes like splits or special dividends, and importantly, secondary offerings when a company sells more stock usually pushes the price down initially.
Okay. This all feeds into stocking stocks and setting alerts,
Right.
right? What's the process?
Yeah, stocking is building your watch lists. The book calls them minder lists. Organic ones you know well, tracking ones, alert ones.
And alerts.
Set specific price alerts, visual and audio, for compelling setups, especially those perfect storms brewing on wider time frames. But crucially, write down the setup and your game plan for each alert.
So you know exactly why it triggered and what to do.
Precisely. And don't set too many. Avoid diluting your focus and efficiency. Quality over quantity.
The book talks about anxiety, good versus bad. What's the difference?
Bad anxiety comes from being unprepared. That feeling of uncertainty, not having done the homework, it leads to chasing panic exits, maybe tilting after a loss.
And good anxiety.
That's just the natural tension, the alertness that comes with being in a trade, managing risk. It's focus, not fear based on lack of prep.
So preparation is the antidote to bad anxiety. What are the key pre-trade preparation steps?
Reviewing your stocking minder list, doing that fast chart analysis on key stocks and the indexes, SPY, QQQ, DIA, checking for news, analyst ratings, planning your entry-exit levels, targets, setting up your order screens, and then patience, waiting for your trigger.
Okay. The book covers common trading maladies and remedies. Can you give an example?
A really common one is giving back morning profits. You have a great start in the wet morning climate.
Then keep trading aggressively into the dry midday chop.
Exactly. Ignoring the shift. The remedy is simple but hard. Recognize the climate change and adjust your activity. Dial it back, trade smaller, or even start for a bit.
And the frustration of a setup failing midday.
Yeah, playing something that worked at 9:45 a.m. but flops at 11:30 a.m. in dry conditions, only to work perfectly later at 2 p.m. when things pick up again. It reinforces the need to identify and adapt to those microclimates within the day. Pace yourself.
Trade journaling is also emphasized. What's the recommended method?
Writing a first-person narrative of each trade. Your thinking, the why, the entry-exit details, how you felt.
And screenshots.
Yeah. Yes, screenshots with annotations. Capture the chart context at the time of the trade. This whole process really helps pinpoint nuances and patterns in your own behavior.
Finally, the book gets into portfolio trading.
Yeah.
How's this presented?
As the ultimate destiny, combining all the skills, scalping, swinging, investing, it's about managing a portfolio across time horizons.
Moving beyond single trades.
Right. It challenges the static 3-to-1 risk-reward idea, acknowledging risk-reward is dynamic in reality. Needs that continuously fed stocking minder with alerts. Macro analysis, SPY, QQQ, DIA, is part of the morning ritual for position trades.
How to start.
Start small with position sizes for overnight holds. Build comfort. Adjust allocation based on market trend and climate. The book outlines different position setups too, daily perfect storms, breakouts, overnight gaps with typical holding times and research levels needed.
There's a case study. APP stock. Illustrating swing to core.
Yeah, APP, turnaround story, Soros involvement, past highs, CEO buying. Started as a swing trade based on technical breakouts. Daily, weekly, monthly, mini-pup perfect storms.
And then
Scaled out some profit, but then converted the remaining shares into a core long-term position based on the strengthening fundamental story. Shows that fluid transition.
So active portfolio management is about integrating everything.
Exactly. Seamlessly shifting between scalping, swinging, core holding based on the stock, the market, your analysis.
Options come into play too. Covered calls.
Mentioned as a way to generate income from swing core positions, selling calls against your stock, using weekly, monthly bumpers as straight guides, need liquid options, mine commissions.
And bullish call debit spreads.
Briefly explained as a defined risk directional strategy. Buying one call, selling a higher strike call, limits potential profit, but also limits risk, controlled bet.
What about weekend work for portfolio managers?
Key activities. Macro analysis review, evaluating your open positions, updating the stocking minder, creating the watch list for Monday, and deeper research levels 3 and 4.
It's about harnessing this hybrid evolution, right?
Yeah. Gradually allocating more capital to position trades as comfort grows. That fluid movement between styles is the mark of the hybrid market predator.
The book ends on a more philosophical note. Nourishing spirit. What's that about?
It's about the non-technical side. Real heart, tenacity, the stuff that gets you through inevitable setbacks.
Because trading is hard.
Incredibly hard. It contrasts conventional thinking, just follow the rules, with needing context, landscape, climate, terrain. Shares the story of George Soros blowing up an account before his huge success.
So failure isn't the end.
Can even be a reset. An account blowout, while painful, can relieve tension, force a reevaluation. Spirit, the book says, becomes most visible and intensifies during the toughest times.
The appendices seem useful too, pattern formations.
Yeah, briefly covers basic patterns, trend, consolidation, reversal. Mentions the author uses tools for automatic pattern detection, like ABC patterns.
Trading tool.
Lists key tools, pivots, floor, Globex, fibs, a combined market internals indicator, CMI, volatility indicator, VLTY, bar time indicator, superbars. Briefly explains their use: support resistance, trend confirmation, volatility, entry timing.
And example trades.
Includes examples like intraday futures trades, showing how the tools and patterns are applied in practice. ABC bullish double bottom examples.
Okay, wow, we've covered a lot.
Yeah.
After digging into ways of the trade, what are maybe 2 or 3 key takeaways for our listener to really think about?
Okay, key takeaways. 1, recognize the market structure has fundamentally changed with algos, even if their specific tactics keep evolving. You have to account for that.
Right.
2, adapting to the market climate, wet or dry, trending or chopping, is absolutely crucial for effectiveness. Don't fight the tape, understand its condition.
Accept.
And 3, that relentless focus on process, deep preparation, and consistent effort. That's presented as the bedrock, the thing that leads to the byproduct of profit over the long haul.
All right. Here's a final thought to leave you with. In today's markets, increasingly driven by AI and complex algorithms, how can cultivating those human elements the book touches on, that spirit, adaptability, resilience, provide a lasting edge that pure code might struggle to replicate?
Something to ponder. Reflecting on these ideas from ways of the trade against your own experiences, maybe even revisiting the source, could be really valuable for refining how you approach the markets.
Absolutely. This deep dive hopefully gave you a more efficient way to absorb some of the key insights from this dense resource. Until our next exploration, keep learning, keep adapting.